Thanks very much, Walter, for your insights. Our next speaker is Saul Miller from Truffle Asset Management. Saul is one of the 4 co-portfolio managers at Truffle, responsible for managing the award-winning Nedgroup Investments Balanced Fund. They utilize an agile approach to asset allocation and stock selection. Looking forward to your presentation, Saul.
Thank you, Anil. This is the performance of the Balance Fund going back to inception. Over here, you can see what contributed to performance and what detracted to performance. So post our election and the formation of the GNU, that was obviously very good for South African assets. And you could see it in SA equity markets. You could see it in financials. So you'll see that's quite a substantial contributor to our performance. We also have had the rolling over of the offshore interest rate cycle, starting with the US and Europe cutting rates. That has also been good for SA assets, and it's been good for our bonds. And you'll see bonds have also contributed generously to performance over here. We had a small position in oil and in the platinum group miners, and that detracted a bit from performance. With that, I'm going to move on to my economic overview. We have moved our exposure much more in favor of SA over the last couple of months, and that's really what I'm going to end off with. But before I discuss that, I'm just going to touch on the US and China. So starting with the US economy has been very resilient, certainly more resilient than we expected, and there are a number of factors that are responsible for that. So here's a slide you've probably seen you've seen that we've put up before. This shows you mortgage rates for consumers. So it's the mortgage rate for existing consumers, which is the lower line, and the upper line is the mortgage rate for a new house buyer. Now, in the US, mortgages are fixed for 30 years, so it's quite different to the rest of the world and certainly different to South Africa. But essentially what that means is these massive hikes in interest rates that you've seen in the US over the last 2 years actually haven't impacted mortgages because they are fixed for 30 years. So consumers have been sheltered from this very aggressive monetary policy tightening. That's important because the bulk of consumer debt sits in mortgages. So hence, the impact of tighter monetary policy has been quite dulled this time round. Now, eventually, people have to buy new houses. Either they retire or their families grow, and then they will have to refinance at the much higher rates that you see in this chart. But that is more of a medium to long-term headwind for the US consumer. The second major aspect that has really contributed to strong GDP growth in the US has been government. So budget deficits in the US are very high at the moment. They're sitting at over 6%, so it's more than double of where they have historically been. That is going to have to be reined in over time, and that doesn't matter whether it's a Republican or a Democrat or Democratic president that comes into the House. At some stage, you are going to have to rein in those deficits. And the reason is particularly evident from this chart, which shows you the US debt to GDP, and you can see it's been on an upward trajectory. It's now higher than it was after World War II, and the only way you're going to bring this down is either by raising taxes or cutting spending. Might not affect the US economy in the next year, but it certainly will have a negative impact over the next few years. If we look at valuations in the US, and what you have here is the S&P, and you also have the S&P with the Magnificent Seven excluded. In other words, the tech shares like Amazon and Tesla and Apple and so on. And what you can see here is even when you exclude those shares, if you look at the line in green, it is still pretty elevated. It's at 19, which is quite well above the long run average. Now, we're not saying the US market is going to collapse anytime soon. We just think that there are better places where you can get better risk-adjusted returns in the world, and SA would be one of those places at this stage. Moving on to China. The big issue with China has really been an issue around consumer confidence and how can you get consumer confidence to recover. Now, there are a number of potential reasons for why consumer confidence in China is depressed. First of all, we've obviously got economic growth that has been slowing in China. Secondly, there's been quite a lot of draconian regulation in China, which has obviously impacted corporates negatively. There are geopolitical risks and tariffs, which also affects corporates. This obviously makes consumers worry. And the other thing that would obviously worry consumers would be rising unemployment rates. It is particularly elevated in terms of the youth, where it's been rising quite aggressively. Another major factor that weighs on consumer confidence has been property prices. So you've got property prices that are coming down in China, and in addition to that, they are also at very elevated levels. In other words, the price of property is still very expensive in China. If you look at some of the major cities, you're probably looking at rental yields of less than 2%. So it's not just expensive in absolute terms, it's actually quite expensive if we compare it to other major cities in the world. That will obviously weigh quite substantially on consumer confidence. So what we've had and what we've been seeing for the last few years are obviously continuous rounds of stimulus. Recently, we had a more significant stimulus package being proposed. The question is it enough? We think it's probably not sufficient at this stage. Really, the key part of it has been around bank lending, making it easier for banks to lend, cutting rates so it's a bit cheaper for consumers to refinance. The problem is if you are worried about the economy and you think property prices are expensive, cutting rates is not going to get you back into the property market. So we don't think this is necessarily going to be enough. There have been some other measures where they have tried to have government transfers to some of the parts of society, the poorer parts of society that have really been struggling, but we haven't seen anything substantial. You might get something. Maybe we get something in terms of healthcare or in terms of pensions. But even if we did get a significant stimulus there, it still isn't clear that consumers would want to start spending again. They might just still continue to save as they have been doing. So we think markets have overreacted to this stimulus package that was recently announced. I just have two further slides on China that I just want to touch on. I spoke about property and the fact that property prices are quite elevated. Over here, we overlay the property cycle of China against many other countries that have had property cycles over time. And what you'll see is China, as represented by the red line, is actually quite early into its property down cycle. We've only about 2 years into it. So it really talks to the risk of this taking quite a bit longer to play out. Over here, what you can see are building starts in China. And what you can see here is that they have absolutely collapsed. Now, what goes into GDP on building starts, it's obviously what's in the pipeline in terms of construction. What this means is that at some stage, unless property starts pick up, at some stage what's in the pipeline is going to roll off and you could have a negative hit to your Chinese GDP. Over here, you can see the Chinese market is represented by the MSCI, their various indices. You'll see a similar story, which is really one where we had a substantial recovery in the market post that stimulus announcement, and we kind of went to fair value. So we actually used this as an opportunity to reduce some of our China exposure, which would really be via the likes of a Naspers and a Process. You also saw a run in some of the commodity prices, which we also felt was a little bit unjustified, given that the stimulus package wasn't really so much around fixed investment, and that those rises or increases in property prices were very positive for some of the diversified miners. So they rallied quite strongly, and we reduced our exposure a bit there as a result. Okay, so moving on to South Africa, we're quite optimistic about the GDP outlook over the short term in South Africa, and there are a number of factors that will drive those short-term benefits. After that, we can talk about some of the more long-term considerations. So first of all, we are going to have interest rate cuts, which is not surprising given that we're seeing interest rate cuts globally and we have inflation that is coming down. We've got the introduction of the two-part retirement system as well. Both these factors are certainly going to add a little bit to our GDP growth. In addition to that, post the GNU government, some of the benefits that we've seen, one of them has been around tourism, and there's been a 50% improvement in the visa backlog. There's a major concerted effort to make it easier for tourists to get visas as well as to help skilled workers get visas. You're already seeing that in terms of a nice uptick in terms of tourist numbers into South Africa. And anecdotally, if you've been to airports, you might have also noticed that the numbers are certainly starting to swell. That's not just good for GDP, it's good for our current or our trade account as well, where we get more foreign currency coming in, which is obviously good for the strength of our rand. And then not only do we have oil prices coming down, we actually have the volume of oil imports from Eskom coming down dramatically, given the improvements that we've seen in Eskom. So those two factors are also certainly positive for our trade account, and they are also very positive for GDP. So we could quite easily see GDP in excess of 2% next year. We might get a bit of a poor print in this quarter, in Q3, but we would hope that Q4 looks better, and certainly next year. We could have next year and the year after, we could be looking at GDP numbers close to 2%. Some pundits are even arguing something closer to 3%, but you don't need anything that strong for us to be quite positive on SA markets. Moving on to what we need in terms of more sustainable factors that will drive GDP, because these factors are obviously a bit more short-term. Electricity is obviously one key area where we've actually been doing well. Not only has Eskom been improving the energy availability factor, we're seeing much more drive into renewables from the private sector. That needs to continue. We've also now seen a separation of transmission from generation, which is also important. It means now that that part of Eskom can start raising funds and growing the transmission side of the grid, which should also be hugely positive for growth in South Africa. Transnet is also a key factor for GDP growth. We know that it's detracted a tremendous amount of growth in terms of falling volumes of coal and iron ore and other general freight. What we're waiting for now is an announcement from Transnet bringing the private sector in to manage or operate some of the rail and bringing some of their locomotives on. Now, once that gets announced, it's still probably going to take 2 years to actually see that benefit come through into the numbers. It obviously takes time to get those locomotives and to improve the railway. But if we can get that announcement, that should be very good towards sentiment or foreign sentiment towards South Africa, which should also be favorable for our markets. But the actual benefit of that coming into the numbers will take a bit of time, but certainly could be quite a game changer for our GDP if we look at the long term. There are obviously many other factors that are key, but just the one that I want to end off on is really around water availability. This is obviously a key aspect of SA which we need to fix. What is positive here is it now falls under Project Vulindlela, where we certainly have capable people looking at it. So this is obviously a very important part of service delivery that needs to be fixed if we are to see sustained GDP growth in South Africa. I just want to touch on valuation of some key SA exposed sectors. What you can see here are the PEs, or the valuation of the retail sector. And what you'll see is the re-rating post the election has been quite significant, but we're roughly in line with average values. In other words, values of where we've traded at over the last 10 years. What's important to bear in mind here is this is a period where GDP growth has been quite lackluster in SA. It's averaged about 1%. If we move into this period of 2% growth, there's no reason why valuations of SA assets can't trade at higher levels. What you see here is a similar picture. I'm just using banks, which have also re-rated to fair value or to values in line with their long-run average. But to look at it a little bit more in depth, what I've done is I've taken the current dividend yield that you get from your average bank, and I've looked at the growth over the next 2 years, and you can see you're getting 6% dividend yield, you're getting about 12% growth over the next 2 years. That gives you an annualized return of 18%. So you're getting an 18% return on average for SA banks before you have any kind of re-rating in the market. That is a particularly generous return, and it really talks to why we still have quite an overweight towards SA assets as opposed to foreign assets. If things go well in South Africa, and we get some of the benefits that I've spoken about, there's no reason why we can't, in addition to that 18%, also get a re-rating of valuation, which could take us to over 30% return. The final slide shows the asset allocation of the Balanced Fund. As it was at the end of last month, it's changed a little bit from the end of the month. We have a little bit less equity, as I mentioned during the presentation. As a result of the stimulus in China, we had a very strong run in all things related to China, like Naspers process and some of the diversified miners. So we sold into a bit of that strength, So we are a few percent less than that 76% that you see currently. The other important thing just to bear in mind is that you'll see that offshore exposure is sitting at 31%. That's quite low. Over time, we would normally expect our offshore exposure to be closer to 40%. The reason why it is low is, as I mentioned before, we are positive on South Africa and we are taking a higher exposure towards South Africa, given the reasonable outlook for the country and given the reasonable valuations. With that, thank you, and I will hand over to Anil.